right, good afternoon, everybody. Today is November 10th, 2020, and this is SMB's weekly Options Tribe meeting. The Options Tribe is held every Tuesday at 4:30 p.m. Eastern Time throughout the year. And what we try to do on each meeting is to bring to you options trading experts from all over the world. In today's case, California, in order to give you some information that's going to help you to deepen your knowledge of options trading and hopefully improve your game as an options trader. Before we get started, I wanted to point out that SMB Training is not a broker-dealer. We're doing these webinars for educational purposes only. These are our disclaimers, which you can read when you get an opportunity. And I'd also like to point out that options trading is risky. So you shouldn't expose any of your capital really to options trading until you've done a lot of back testing and paper trading, gotten a good solid education in options. And we could talk about that a little bit later, how you can do that, as well as trading live with a small amount of capital, because you want to start small initially so that when you do ramp up your capital levels over time, which of course would be the goal for anyone wanting to make a living trading options, you don't want to be ramping it up before you fully understand how options are going to respond to different market conditions, big rallies, big sell-offs, whatever. And so you want to make sure you understand that before you have a lot of capital exposed. You don't want to be on that learning curve with a lot of capital at stake. Okay, so with that, I would like to welcome back John Greathouse of cptdashboard.com to talk about how to generate weekly income selling premium, specifically how John does that. So John, welcome back to the Options Tribe.
Thank you, Seth. I appreciate the invite.
Yeah, well, we really love having you, and we don't have that many presentations about covered calls. Most of our presentations are about market neutral strategies, such as butterflies and iron condors and calendar spreads and so forth. And I always think of the covered call as more of a directional trade, in the sense that the essence of the trade is you're long stock. You don't want the stock to go down, but it doesn't mean, of course, that you can't benefit from the stock being stagnant, because then you can sell premium against it. So you're going to be talking about that much more than I am, but I just wanted to sort of share with everyone that today's meeting is a little unique in that we'll be discussing what would not normally be considered in a normal sense an options income strategy. It has to do with earning income through a combination of long stock and short calls, or short puts, however you want to do it, as a cash secured put. But the point is, it is not a non-directional play. There are cases where you can get hurt, as with every option strategy, if the market goes in certain directions. So anyway, I'm not going to steal John's thunder, because there are plenty of times when you make very good money trading covered calls. That's what he's here to discuss. So John, I am going to stop sharing my desktop, and I'm going to have you share yours. Now, I want to remind everyone who's here that we have a, there you go. Okay, great. So I want to remind everyone here that we have a Q&A feature, and we also have a chat feature. I'm going to be monitoring both of those. And John, do you prefer to have me hold off with any questions until you're finished your full presentation, or would you like to take questions as they come up during the presentation?
Sure, we can do that at the very end, because once I get going, as you know, it'll be hard for me to stop.
All right, that's great then. So folks, type your questions in. Feel free to do that. I'm going to be watching them, but I'm not going to be passing them on to John until the end. And then we'll compile them all at the end and put them to John at that point. So John, fire away.
Well, hey, Seth, thank you again for the invite. For some of you, you may remember that I was here about a year ago. We talked about the poor man's covered call. And I'll tell you what, that's one of the most frequently asked videos people want me to do. The poor man's covered call is fun. But one of the most frequently asked questions I get is how to generate weekly income. I call it my weekly paychecks. Now, like Seth mentioned, I sell premium, and I'll tell you what, it's really this simple. I sell the risk, and I try to keep it simple. I'm going to explain who I am in one slide, and I think you'll get it. Now, before I continue, if you haven't seen any of my videos on YouTube, just go to YouTube and search Core Position Trading. What I do is I show you my trades. We talk about them, so maybe you learn something. And every single week, I try to bring a selling premium video for all of my members. So before I get going, Seth talked about bringing in some options experts, and I do appreciate that. What I'll tell you is this: I'm not so much an expert as I am someone that has experience. And you'll understand that part of what I do is I try to motivate and inspire people. And through my experience, I love to share my story. So maybe you, as the options trader that wants to up their game, can pick something that I have done, add it to your game, and maybe you'll become successful. Now, my story cannot be told without telling you about my mentor, Jerry. Okay, I mentioned this a year ago. I always mention this in my videos. 4.5 years ago, I was a losing, unsuccessful day trade swing trader until my mentor, Jerry, my best friend, Jerry, sat me down and he showed me how he generates income in retirement. He sells premium, and that's how he puts food on the table. That's how he pays the bills, and that impressed me, and Jerry helped me. I went from being an unsuccessful trader to someone now that is having so much success, I want to pay it forward. So some 250 videos since I sent Jerry a video on a Saturday morning for which I just wanted to show Jerry a trade that he helped me with. I have a YouTube community that absolutely loves what I do. And I love hearing the success stories. And that's why my channel keeps growing. Now, what I do is I bring it to you straight talk style. And what that means is I try to lower the hurdles so you can get comfortable with it, and maybe you'll have some success. Okay? I try to bring it to you straight talk style, motivate and inspire people around the world. So look, you're going to hear this many times. My motto is simple. I show you my trades. We talk about them, so maybe you'll learn something. I read books, but I just find that if you show me a trade, maybe you show me 2 trades and we talk about it, it's going to sink in, right? It's going to sink in a little bit deeper. I'm going to get more comfortable. And you know as well as I do, if you're more comfortable with something, you'll do it. And that's what I strive to do on my YouTube channel. Okay. Mm-hmm. So for example, I bring it to you straight talk style. Intrinsic value in an option is not intrinsic value in my world. We call it real money. And of course, the time value is called time value. I love breaking it down so you understand it. Now, for some of you more advanced traders, you may find this to be a little basic, but at the end of the day, what I'm going to tell you is this: keep your hurdles low, and when you have success, it'll motivate you for your next successful trade. Now, I know part of the reason Seth brings me back is because I am excited to talk about selling premium. In fact, if you watch one of my videos, if you watch every video, I open every video talking about it's time for another red hot covered call video. Now, who is talking about a red hot covered call trade, right? Well, in John's world, every trade's red hot because I've had success. And I've been doing this since the late 90s when that's when I started all that swing trading, day trading. Didn't have any success. For me, a measure of success is having a green trade because it motivates me for my next trade. So let's talk about what we're going to talk about today. We're going to talk about the weekly paychecks, or what I call the weekly paychecks. We're going to sell premium weekly, whether it be 5 days or 7 days. I'm going to explain that. And what we're going to do is we're going to try to collect a weekly paycheck or a premium profit. Okay. It's very popular because if you go on YouTube and you type in anything about weekly paychecks, you'll see those videos always get the most clicks. People want to use the 1 week opportunity, whether you're trading or you're selling on eBay. That weekly paycheck is enticing. Now, we're also going to talk about the risks, covered calls, cash secure puts. I'm going to explain to you what I mean by that. We're going to talk about my weekly goals for the weekly paycheck idea. We're going to define time decay and what I call my edge. Now, I know most of you already know what time decay is, but I'm going to show you or explain to you what I believe is our edge. Now, I got some hypothetical trades for you. We're going to talk about 4 of them, 3 of them being covered calls, 1 of them being a cash secure put. I got some very important key things I want you to take away from this video and the way that I trade weekly premium trades, whether it be covered calls or cash secure put. And the final part is I'm going to answer the #1 most asked question I get about weekly paychecks from around the world. Mm-hmm. So let's talk about it. Selling premium basics. It's really simple here. I know most of you understand this. We're going to sell a covered or write a covered call, sell a covered call, whatever you want to use. Most people talk about writing covered calls. And we need to own 100 shares, right? We have to own 100 shares of an optionable stock. And we are going to sell somebody the right, but not the obligation to take those shares away from us. Now, of course, that's a strike price because we're going to pick the price. We're going to pick the time frame. That's the expiration. Now, in this case, it's going to be 7 to 5 days. I call that my guaranteed weekly paycheck because that premium is guaranteed. Now, like Seth mentioned, the trade may go haywire on you, but at the end of the day, that premium is guaranteed.
Right. You're going to get that. You get that premium no matter what.
Exactly.
Whether the trade loses money or not is another thing, but you're going to get that cash. You're going to receive that cash.
Exactly.
Right.
Now, the cash secure put is kind of the reverse here. We're going to have the cash ready to go. We're going to tell the greater stock market that we'll buy your shares at a price we pick, and we're going to give them a time frame to make that decision. Now, we're going to get paid a per share premium. And again, it is guaranteed cash on the table. Because again, if somebody takes us up on that right, it's not an obligation, that right, they got to pay us that per share premium. We get paid, and I absolutely love it when I sell the risk, but I get paid. And we're going to talk about that here in a minute. So there are your basics. We're either writing a covered call with the shares we own, or we're selling a cash secure put with the cash we have sitting on the sideline. Now, why is this trade so popular? I kind of mentioned at the beginning, just the words weekly paychecks for anybody out there trying to make the ends meet really gets people excited. So that idea that we can do this weekly, we don't have to wait many, many days or weeks for this trade to end. People love that. They love that idea. And in this case, the weekly paychecks, we're going to talk about the 7 to 5 days, okay? And this is much less than the traditional 30-day covered call that you'll hear most covered call gurus talk about. Also, the lack of time, right? Why is this trade so popular? The lack of time. A lot of options traders love to limit time. And if we can limit the time, we can have more favorable results if you do it right. If you learn the strategy, you can really have favorable trades. So with that said, lack of time, people love it. Time decay really starts to tail off in the last week of trading, as you know. Greater cash on cash percentage gains. Now, if you do have a successful trade and you make max profit where you have your shares taken away and you collect the premium, that cash on cash percentage gain, and I'm going to show you what I like to make, can outpace the annual returns, the annual historic returns of the S&P 500. Love the cash on cash percentage gains for the weekly covered calls and cash secure puts. And of course, the shorter term commitment. A lot of people don't want to have their money tied up for 30 and 45 days. They love the short term commitment. I guess.
John, can you go back a second? Could you define what you mean by cash on cash?
Yeah. So typically when you hear covered call trainers or gurus or experts talk about their cash on cash gains, what they talk about is, say, for example, I buy a stock and I invested $10,000. Mm-hmm. I bought the stock, I wrote a covered call, and I gave somebody the right to take them away $10 higher. And say, for example, I got $1. So if the stock trades above 110 at expiration, they're going to take away my shares. I will have made cash on cash $11. In this scenario or hypothetical trade, that's 11% cash on cash.
Gotcha.
I started with $10,000. I finished with $11,100 cash on cash, 11%.
Understood. Okay. I just need, it's not a term I was familiar with, so thank you.
Sure. Now, with that said, I mentioned this in the beginning. I love selling the risk. And what I mean by that is this. With stock ownership, you're going to find that you'll always have people say, well, that stock can go to zero. Well, yes, it can, of course, right? But when we're trading or using great S&P type companies, the chances of that happening is very minimal. With that said, I always love to sell the risk because remember, the real risk is owning the shares. So what I love to do is sell the risk to somebody else. So when I buy the shares, I love to write a covered call and let the call buyer take the risks of the time decay because they're going to pay me up front. And I can keep my shares if the stock does not finish above the strike price. So for me, I believe the risk holder in this trade is the call buyer because they may pay me money. And if they let the trade go to expiration, that paper they're holding, right, that call option they bought the right, that can go to zero.
Right.
So that's why I love to sell premium because I feel like I'm selling the risk. Now, with that said, all trades are risky and holding the stock can absolutely crush you if it goes against you. Okay. Mm-hmm. So what is my typical weekly goal? Well, for me, in my experience, it's been 1%. I know that doesn't sound like a lot, but if we can generate between 0.9 and 1% on a 5-day, 7 to 5 day selling premium trade, whether you own the shares, write a covered call, or own the cash and sell a cash secure put, my goal is 1%. 1% being on the high side. Now, I know that doesn't sound like much, but when we can buy a stock and then we can get a little stock appreciation plus the premium, it starts to add up. And when we do this weekly, well, with 52 weeks in the year, you can see there's opportunities throughout the year. And a lot of times I find myself picking a stock and I will try to do it 25 to 30 times a year. And with that said, I have had success, but when I place the trade, I'm looking for that 0.9 or 1% cash on cash gain.
So you're comparing that 1% to what? To the value of the stock, 100 shares of the stock, or what's the denominator of that 1%?
Yes. The way I would calculate that would be, again, going back to my example of buying a stock at $100, what I'm looking for is a combination with an out of the money strike, a one price out of the money strike plus the premium. I want those two to equal 1%.
I see. 1% of the price of the stock.
Exactly.
Okay.
Okay, so again, coming from the selling premium side of this, right? I always think of time decay as my advantage. Now, option buyers might use that to their advantage as well, but me being primarily an option seller, I believe time decay is on my side of the field, right? I believe I can use that to really pick my strike prices so where I can be more successful. So if you understand time decay, you understand that on a 30-day trade, the time decay does not erode the option price and out of the money option price. Again, I'm assuming that we sold the out of the money strike. So the stock is not above our strike price. So as the month moves to expiration, slowly but surely that option is going to erode. Now, with that said, the first 3 weeks, you're not going to get much movement. But as we get into that last week, it literally falls off the table. This is where a weekly paychecks trader will find success. If you're just looking to pick up some crumbs, that 1% I talk about, and by the way, I call them crumbs, okay? I pick up 1 crumb, 2 crumbs, next thing you know, we're talking real money, okay? That's John's straight talk style. So with that said, that is our edge. That's our edge. We own the stock. We pick the strike. We pick the expiration. They paid us. I feel like I'm the house, right? You've heard of that, the casino, right? The house always wins. That's how John feels. I believe I'm the house. I have set up my trade where it's very favorable for me to have success. Now, whether that happens or not, I'm not sure. We have to see how the trade plays out, but you get my point. We're going to use that last week as our edge. Okay, so let's talk about selling premium. And I think this is super basic, but I always love to talk about it because it just reinforces to me that I have picked the correct strategy to trade the stock market. Because when we sell premium, there are basically 3 outcomes, and 2 of them we win. The third one, we still own the shares, but we win on the other 2. So in this case, number 1, if the stock goes above our strike, we collect the stock appreciation and any premium. That's a win. I call that a max profit. And by the way, how many times in your life have you told somebody, I make max profit all the time? And I'll tell you, so many times when I was swing trading, day trading, I lost all the time. I wasn't good. I'll be honest. But now with selling premium, that's totally different. With that said, the second way we can still win is stock trades sideways. It does not trade above the strike on expiration. We keep the shares. We hope the shares are a little bit higher. That's a little stock appreciation that we haven't realized yet, but we keep that premium, and we're going to go ahead and write another covered call. Now, the way we can lose here, and really it's from your perspective, okay, the stock finishes well below the expiration, or pardon me, the strike price. And in fact, it's fallen below your stock purchase price. Now, most will tell you if they're short-term traders, that's a loss. But if you're going to use great S&P type companies for which you would hold in your portfolio anyway, well, I'm going to advocate that that might be an opportunity to write another covered call and profit again. So it's really how you want to look at it, but we can win definitely 2 times out of the 3 possible outcomes of a selling premium trade. Now, of course, the cash secure put is a little different. I guess these 3 here really focus on the covered call, right? We own the shares. We're giving somebody the right to take them from us. With the cash secure put, it can, you're either assigned the shares and you're really hoping you're assigned the shares at the strike. I guess it could go really bad if you sold a cash secure put at, say, 100, and by the time the option expires, the stock is now trading for 80. You'd be assigned the shares at 100, and of course, you're down 20 bucks already. Now, granted, the premium you collect would be considered your cost basis reduction, but if you're spending that money like I do, guess what? There's no cash, there's no cost basis reduction there because I've already spent the premium. Really depends how you look at that. So let's talk about, before we get into the hypothetical trades here, let's talk about defining your risk tolerance, because I think there's essentially 3 types of traders out there, and really you need to be a self-evaluator. Are you a steady as she goes type trader? Somebody that just wants to play a little 40 to 60 cent premium trade on the highest of quality stocks? I'm going to show you an example of that. That's one of my favorites. Are you someone that likes action? You're an action trader. You'll play those high volatile stocks. You'll really get into the implied volatility and you will just look for the big premiums. And to be honest with you, you're a risk taker. Or are you, I own the shares whether the stock goes up or down. So you'll sell premium and it doesn't matter where the trade finishes. You figure you're going to own the shares anyway. I talked to hundreds, if not thousands, over the past 4.5 years doing my YouTube channel of people that do just that in retirement. They use their shares in their portfolio to generate monthly income in retirement. Now, that's a little different than what we're going to do here with the weekly paycheck, because they'll do the 30-day and the 30 delta and all that stuff. They just want to pick up a little extra income in retirement. But if you're that kind of trader, I've got an example for you as well in this hypothetical trade slideshow. So before I get to the hypothetical trade, Seth, do we have anybody that's really hitting you up with any questions? I guess not. I'll go ahead and start with hypothetical trade.
I'm sorry, I was on mute. You weren't hearing what I was saying. We don't have any questions that cannot wait until until the end of the session. So
excellent. Sounds good. Hey, feel free to ask your questions. I've pretty much experienced it all. Okay. If anything, if I can't answer your question super technical, I could probably give you an example of how I experienced it. So let's go ahead and talk about my hypothetical trade number 1. We're going to use the in the money covered call. Okay. Most of you probably know in the money, at the money, near the money, out of the money options, right? Mm-hmm. So in this hypothetical trade, what we're looking to do is use the in the money covered call. So really what we're playing here are some very tight premiums. And all we want to do is make those little crumbs. Now, if you only have 100 shares, these little crumbs will be like 45 bucks, okay? But if you're somebody that has enough to buy more than 100 shares, this becomes real money. So in this example, if you notice, the in the money covered call, for the most part, assumes your shares are going to be taken away, right? If we are writing an in the money covered call, only giving 5 days, and you're trading a great company that's trading sideways to higher, chances are that stock's going to finish in the money or above your strike price. Now, for you that might not know what in the money means, say you buy the stock at 100 and you give somebody the right, but not the obligation to take those shares from you at 90. Okay, so the likelihood of your shares being taken away are pretty good. So what you need to do is focus on that time value. That's your profit. A lot of people don't understand the in the money when we get deep into the money, that real money component of the in the money, that isn't profit. I get emails all the time where people say, hey, John, I did this trade. I bought the stock at $100. I sold the in the money 90, got paid $11, man. I am dancing in the streets with my $1,100 profit. Well, of course, you know, $10 of that is real money. So what we want to do is focus on that time value element of your option. So when you do your math for a profitable trade, that 1%, make sure you're just accounting for that time value. Now, in this case, I give you some examples there. Using 5 days, this is very conservative, very conservative. And this is one of my favorite trades. I call this a little crumb. Collect 1 crumb, 2 crumbs, all of a sudden we're talking real money. Okay, so hypothetical trade number 2. We're going to go ahead and add a little bit of time to our options. Now, do you remember in the beginning of the slideshow, I talked to you about how I like to add 7 days to a weekly option. And for me, when I started selling premium weekly, what I realized was this. On the stocks I was looking at, if I found my stock that I was going to use on the Thursday preceding the next Friday's expiration, I was finding I could pick up an extra 30 cents in some cases on the companies I was using. Meaning, on the Monday, if I bought the stock and wrote the weekly covered call, I might pick up 50 cents for that premium. If I bought the stock the Thursday before, I might be able to get 80 cents. It's that little 2-day adding of time adds to the premium or adds to your weekly paycheck. And you can see in the example right there, I did this many times. This hypothetical trade shows that on Thursday, I would have picked up a premium of 85 cents and I'm selling 1 strike out of the money. Again, I'm keeping my hurdles low. We're not doing a $5 and $6 out of the money. You're not going to get 85 cents in a 7-day window on these great S&P type companies, right? What we're looking for, 1 strike out of the money, try to pick up a little crumb. I noticed on Thursday, we can pick up 30 to 40 cents more. And that's what I would do. And of course, if the stock starts to tail off like my little graph there, because time decay is compressing that option time portion, that option that I got paid 85 cents, if it's not above the money, you will realize every day that goes by, that 85 cents goes to 75, 65, 55 real quick. And what do I like to do? Come Wednesday, if that stock's not going to finish above the strike, I buy it back. Yeah, I get 85 cents. I'll pay 5 cents and I'll do it again. We repeat and rinse. And to be honest with you.
So that way you roll your capital over every Thursday because you've got to close that.
Yes, most definitely.
Right.
Yes.
Yeah.
Now again, that's not a rule. That's just something that I've found through my experience. And understand, I'm going to use that Friday's expiration. Chances are this stock, I probably have held it. Maybe I did buy it. But anyway, you're exactly right. I will try to find my weekly covered call stocks or cash secure put trades on the Thursday preceding the next Friday, just to get that extra little crumb. Because again, I'm trying to make 1%. All right, so hypothetical trade number 3 really has to do with where you're at as a trader. Remember we talked about you have to do a self-evaluation. Well, that third one we talked about was you're going to own the stock anyway. And in these cases where I'm going to use news events, I want to make sure I'm trading those stocks. And what do I mean by that? It's really simple. There's some great news events that move option prices wildly. And you know that. Now, if you're using your stocks or the stocks that you've researched, the stocks that you have elected to own, right? You'll own them whether they're up or down, right? I own a lot of stocks for which I've been down as much as 30%, but I believed in them. And that's a golden rule, by the way. The golden rule of cover call writing, number 1, you got to want to own the stock because, again, that's our biggest risk as a cover call writer. We have to own those shares.
Right.
So
once you lose faith in the shares, you know, it's the risk of the shares going down offset the value of getting the income periodically.
Exactly. So in this hypothetical trade, notice, and by the way, I wanted to clarify this because I get this all the time. John, you know, how are you saying you're making all this premium profit, yet you're down on the shares? I won't get specific, but trust me, I've been down on some shares, and here's John just trumpeting the fact that I've made all this premium profit. But this is where, for me, it's a mindset. Now, I know a lot of your traders probably just rolled your eyes because mindset is that thing you really can't grab onto, but that's part of what I do. It's about having a positive mindset or a mindset of success. Okay. And it allows me to make these kinds of trades. Now, in this example, this person clearly is losing money on the stock because the stock was trading 137.50, and earnings report happened that night. The stock collapses some $10, and their option, if they sold that at the money or one strike out of the money option, in 5 days, the premium is probably damn near a dime on the very next day. But having the mindset that that's okay, because I collected the premium, I'm going to own the shares, and I'm going to go ahead and write another covered call. A lot of people love to use events, whether that be an ex-dividend date, whether that be a earnings report, same store sales. There's a lot of events out there that affect options pricing. Now, I rarely talk about implied volatility. And I'll be honest with you, I pick my stocks that I'm going to use based on the stock. Okay. I'm not going out searching implied volatility. I'm not going to websites looking for volatility, looking for deltas and all this. No, I am going to start my research with the stock. Then I'm going to go from there. Okay. So in the case of this particular hypothetical trade, talking about volatility, you probably could have gotten, in a scenario here, much more premium around this event versus any other time. So using an event adds volatility, and that can really increase your premium profits.
So could you run us through this example, John? Where was the stock trading roughly when you entered into the covered call?
Yeah, so this stock is one that somebody might own. If we're looking at the chart, you may have bought this stock a week ago, months ago, years ago. So when it's trading at 137.50, your cost basis could be considerably less. Remember, Seth, this is a stock for which you've owned and you don't mind holding whether it goes up or down. Okay. So to answer your question, where's the stock trading? At this point, it's trading for 37.50. But you, the stock owner, Well, you may have bought it at $100. So you're going to play the events. And that's what I'm trying to express with this chart. Did I answer your question on that?
Yes, you did. Yes, you did.
Okay. So obviously events affect option pricing. Going back 2 trades, we talked about using that in the money covered call. If there's no events, I mean, that can be a smooth sailing trade with the expectation, with your expectations probably met if you did your homework, if you did what you had to do to make that a successful trade. Now, when it comes to events like this, I'll tell you what, earnings can swing some of the biggest names on the planet 10 and 15%. I'll never forget 2 years ago, I did an example of Nike, one of my trades for which I held Nike for months. And I did a graph for which Nike, one of the biggest companies on the planet, right? Around earnings, they moved 10%. And this is when it was trading for $60. Mm-hmm. So do the math on that. So events can really, hey, if you take advantage of them, they can be profitable.
But if it's a stock you want to own, this is a challenge I would make to that. If it's a stock you want to own and it has a great earnings report and the market loves it and the market rallies, your shares could get called away well below the price that the stock ends up ultimately getting to because of a great earnings report. So you're giving up that appreciation potentially.
Yes, exactly. Mm-hmm.
But on the other hand, if it's a strike, 1 or 2 strikes up, you've already got some of that appreciation. Plus you got the credit, which essentially anticipated some of that appreciation. So, it's not the end of the world. You still made money on it.
Yeah, most definitely.
Yeah.
So real quick, Seth, let me throw a little more mindset into the conversation. See, I'll tell you, I get this all the time from so many buy and hold investors. You don't even know. I mean, right now I'm doing video series on my channel where I do case studies where I show the selling premium trader versus the buy and hold, because so many times people tell me, hey, John, had you just owned the stock or just held the stock? You have to understand, I've been trading NVIDIA for years. And yeah, if you know the price action on NVIDIA, John's left a lot of money on the table by selling premium. But again, understand that when we create weekly paychecks, what's the goal? Cash on the table. We're paying bills. We're buying food, right? We're living the good life. Remember, it's a mindset. Weekly paychecks, cash on the table. That's my goal. So here's one of my favorite, okay? I left this for the end because it's the cash secure put. And to be honest with you, I was going to do one today. I love to sell an out of the money cash secure put on a stock that I want to own. But what I love to do is use the 200-day moving average. In my videos, I always talk about a low risk entry purchase, okay? And I have little indicators to help me give me conviction for me getting a low entry purchase, okay? I'll use the Keltner channel. I'll use the RSI. I mean, none of this is groundbreaking news. But when I use all of my indicators together, I always sit back and say, okay, that is a low entry purchase. And that's what I want, because I want to buy when the fluff is out of the stock. Now, I use cash secure puts for this. A lot of times I'm not assigned the shares because over the years, my experience with this particular weekly covered call has been pretty good. What I love to do on stocks that are trending lower, a little bit lower, sideways to lower, I'll come in and find those stocks that might be trading near their 200-day moving average. And for me, what I've found is the 200-day moving average. If Wall Street loves the stock, that's where they're probably going to support the stock, that 200-day. It's not guaranteed, right? None of this is guaranteed. but it's that 200-day moving average. They'll come back and support the stock. So I'm using great stocks, right? I don't mind owning these great stocks. So what I'll do, I'll find a strike out of the money. In this case, you notice the stock is trading for 100, and I'll come in and sell the out of the money $90 strike. But the idea is it's below the 200-day moving average. Now, in this case, I don't want to own the shares. I'm looking for a 1 week, a 7 to 5 day trade where I can collect some nice put premium, but the likelihood of me being assigned the shares is unlikely. Now, again, you can do this at the money, a little bit out of the money. Works the same way as a covered call when we try to pick our strikes. And you can do this in the money as well. Again, you just have to make sure you look at your time premium as your profit. And of course, if you're assigned the shares, then what we're going to do is use that stock for next week's weekly paycheck. We write a covered call. So to me, it's a win-win. If you use a cash secure put, you can be assigned the shares, collect the premium, write the covered call, collect the premium. And if you can do this in a nice little window, you can be very successful.
Yeah, you got to be careful in those cases where you get assigned the shares that you don't sell your covered call below. You don't sell your call below the price that you acquired those shares. Otherwise,
yeah,
you take
most definitely, and
you take a loss. Yeah,
yeah, most definitely, and that's where you're going to probably roll your options. Okay, you're going to really need to get comfortable with exit strategies, right? We always manage trades, right? We don't put on a trade, walk away. We always put on the trade, and for the most part, we hope it goes our way. But the reality is they don't sometimes. Recently on my YouTube channel, I just talked about a stock for which I had to roll a cash secure put twice, 3 trades to try to roll out of a bad situation. So you have to be able to use your exit strategies. And you have to have the confidence to do that. A lot of people aren't so confident to be rolling and doing all the math to get you out of a bad trade because you're in a bad trade. And sometimes we make bad decisions when we're not thinking clearly. So look, those are my 4 hypothetical trades. We have a couple more slides, so don't go away. And I'm going to answer that number 1 question at the end. But I have a treat for anyone that's interested today. I'm going to do a special podcast where I'm going to talk about 2 and 3 other weekly paycheck trades that I love doing and share with you my experience. Okay, so what I want you to do is at some point, I want you to go to my website, cptdashboard.com, and click podcast and send me your email. Okay, because I'm going to send that special podcast out for everybody that's on this webinar. Nobody else will know. Okay, so before we get to those questions, Seth, I know a lot of people are already dialing up some good questions, and they're going to talk about these things right here, I'm sure. I get the question all the time, John, talk about Delta. And the best way I can explain it, when I'm doing my weekly covered calls, I just can't use Delta. For a 30-day, I can use Delta. I do that all the time when I do my covered call writing to double my dividends trading strategy. I use that 30 Delta because I don't want my shares taken away. I want to collect that premium, have the stock finish below my strike price. I collect another dividend, right? It's a mindset, right? Well, with my weekly covered calls, I don't even look at Delta because I am looking for premium, my 1%. I'm using my favorite stocks I'm willing to own, willing to hold, and I'm going to sell premium, and I'm looking to make 1%. Now, implied volatility. Well, again, I know a lot of your traders probably go to websites, maybe your website, to look for implied volatility trades. I use my basket of stocks. Now, of my basket of stocks, I have high volatility stocks, mind you. But with that said, again, that does not enter my mindset when I do these trades. It's about the company and getting a feel for the strikes, right? Getting a feel for where the stock trades. And for me, I can make some very quick decisions. So I focus on the premium again. Now, beta is something I rarely talk about, but I threw it in here because somebody said you better mention beta because I know your members are definitely much more experienced with all of this than I. Really, for me, it's about that steady Eddie stock using companies like Microsoft, Bristol Myers, Merck versus Roku, Zoom. And again, it goes back to that slide that I talked about. Where are you as a trader? Are you a steady Eddie? Are you an action player? And are you somebody that just, you're going to hold the shares anyway? That'll probably dictate your trading strategy. And so for me, the weekly covered call, the weekly cash secure put really is about premium, the kind of premium I can make, because I'm going to use great stocks that I have researched and I'm willing to own. Seth, I'll give you one little bit of the way I judge stocks. I always tell everybody, if I'm sitting at the table and I have to explain to my wife why I have lost serious amounts of money with the stocks that I've owned, I better be able to explain it. And if you can't do that, then you need to sit back, sit on the bench, and really do that self-evaluation, because that's not a good place to be in if you don't know why you're losing money. Now, here's some key things to always consider, and of course, I've mentioned this 3 times, the golden rules of covered call writing. We need to own the stock, right? So if we're going to own that stock, I need you, or whoever in the greater world is listening, I need you to want to own it. I cannot tell you how many times I get emails where people say, I bought this stock because I watched a guy on YouTube talk about it, and now I am literally losing unlike I ever have before. How do I get out of it? That's what you need to do. You need to start with the stock, understanding its story, understanding its profits and dividends and earnings and all that stuff, and then make your decision at the very end and then look at the premium. So many times people come to me saying the very first thing they did was look at the premium. And I've said this many times on my videos, Seth, if you work from the premium back, you'll never get to where you need to be for the research. And then you're holding a one-hit wonder stock. In fact, I think I'm holding one of those right now, but I won't mention that here. But it happens.
No question. Yeah. If you don't think of this as that's why I say to people, you've got to realize a covered call is not a non-directional strategy, because you're talking about owning shares long. So if you don't fundamentally have a confidence in owning those shares, you shouldn't be playing around with the potential of owning those shares.
Most
right?
definitely.
Like in a short put, or these have to be, and so one of the questions that came in is, what are the, well, we have sort of 2 questions that are similar. What are the most common stocks you use? And what are your criteria for picking those stocks?
So let me answer that after this, okay? Because I know we're running tight on time.
Yes.
Let me just finish by saying, using the weekly covered call, one of the things I love to consider, because I've had the most success, of course I speak from my experience, is that one strike out of the money. Again, we keep our hurdles low so we can have success, so we can do it again. And also managing our trades. I will buy back options all the time to go ahead and do the next trade. I mean, I can tell you so many times where I could have bought back an option, have no obligation, sell another covered call, and made even more profit. But I didn't. I let the trade go to expiration, and I find myself really wishing I would have done that. I call that double dipping, hitting a single, double, triple in the same time frame. We want to manage our trades. Okay, so the number one question, okay, Seth, and then I'll get to your question. The most frequently asked question all the time, never ever fails. I mentioned this in the beginning of the video, and some of your members may have said, wait a second, he only does this 25 times. There's 52 weeks in a year. Why can't you do this every single week? Now, okay, I've tried. And what I've found is because I'm a selling premium, I own shares. I'm a selling premium trader. Just like Seth mentioned earlier, there are times where I'll buy a stock at 100, I'll write the first covered call, collect the premium, the stock falls to 95. Well, I could try to write the next weekly covered call, but chances are I'm going to be rolling that up or down because guess what? It's not going to finish above my stock purchase price. So usually what I do is I put that stock on the bench. And now I'm hoping I put it on the bench for a week, but sometimes you got to sit your stocks on the side. That's why I mentioned you want to have a basket of stocks, maybe 3 or 4 stocks you can go to throughout the month, right? Throughout the month, but we're writing weeklies. And sometimes I got all of my stocks going on weeklies, and other times I only have 1 or 2, because you might find yourself where the next covered call you write is under your stock purchase price. And that's a bad spot. So many people find themselves in that spot and they don't know how to handle it. I'll tell you, I hate to answer it, but I tell you, sometimes you just got to sit on your hands. You really do. I hate to say that because I know everybody wants an answer. Right? They want the perfect answer to, but sometimes you have to pump the brakes. And that's why I say I try to do it 25 times. And if I were to make 1%, hypothetically, I can make 25%. That beats the annual historical gains of the S&P 500.
Beats the hell out of it.
Yeah. Fist.
Yep.
Well, Seth, I'm going to let you go ahead and ask those questions.
All right. Well, we've got a few, and let's circle back to how do you select your stocks? Because as you've said, John, wisely, if you're not willing to own the shares, if you're not high on the stock itself, this is the wrong game to be in. So how do you choose those shares? Okay, so over the years, I've evolved. And when I started originally, I used stocks that were in my portfolio. In fact, if you go to cptdashboard.com and watch the video of Jerry and I advocate everybody to do that. It's just a 6-minute video about my mentor, Jerry. He showed me how to sell premium with a stock for which I was holding for years, and I was going to sell it for a profit. So the stocks I'm using, or pardon me, the stocks I'm using can be the ones that I've already owned. Now, the criteria to buy those stocks might be to buy it for a little stock appreciation plus dividend capture. And as you learn the selling premium strategy, you'll write a covered call on those shares and you'll have some success. Now, what if I want to put in new money, new skin in the game? Well, I have some simple golden rules. Number one, absolutely want to be diversified. Okay. I want to be diversified. So just because Apple is blowing up and it's about to split, and that's the trendy thing to do is to buy Apple. Well, I'm not going to buy Apple if it puts me out of my diversification. So I'm going to buy a stock that I'm going to be diversified with. So what I'm going to look for is a stock I want to own. It fits my portfolio for diversification. I have a 2 to 3% dividend requirement. Hey, look, if a stock goes bad, I want it paying me. All right, I want paid for putting my money at risk. So it better have a dividend. And then obviously, I love to own the great stocks that I know. This goes back to, I think it's Peter Lynch, right? Just buy what you know, right? And a lot of those stocks that you know are the big S&P type companies with tons of volume. Now, when we talk about buying stocks, we want to make sure they have tons of volume. They have weekly options,
right? Their bid-ask spreads are pretty tight, meaning your bid-ask spreads are 1 penny, 2 pennies versus 10 cents, 20 cents. Trust me, I've traded some leveraged ETFs on the Dow, S&P, and NASDAQ, and those bid-ask spreads are 10 cents either way. And from my experience, man, they will not give up that bid and ask. I'm gonna tell you that right now. Whereas if you're trading a Microsoft where the bid-ask spread is literally a penny, the stock can literally tick down and tap you out. So I'm looking for volume. I'm looking for open interest, right? When I'm buying these stocks, that has to be there. Because if I buy a Southern company or, one of these utility stocks, if they don't have volume, they don't have monthlies, they don't have weeklies, then I'm limiting my opportunities for success because I'm not going to be able to write covered calls on them. So,
John,
those are some criteria that I love. And I also love buying when a stock I'm watching is below the Keltner channel mid. Talk about this all the time. The Keltner channel pretty much represents a stock's trading range. Anything above the Keltner channel mid, we start to get in the fluff. RSI is usually very bullish to being overbought. But when that stock comes down below the mid and trades lower, I always feel like I'm getting a low entry purchase. So that's what I love to use, those indicators. And
hey, John, why don't we try to ask one more question that's come up in 2 or 3 different ways? So I'm going to consolidate them.
Sure.
And that is, why do you not use, instead of stock, go out and buy a leap or go out and buy an in-the-money call farther out in time and then just keep selling against that? Have you ever thought about doing that, or do you do that?
Yeah, of course, that's the poor man's covered call. Right. And I would tell you that's very popular. And that is a synthetic trade, right? That is the essence of selling premium.
Right. Correct.
Right. So yeah, if there's anything you like today about collecting cash from call buyers and put buyers, pardon me. Use the poor man's covered call. It works great. Now, do I? Yes, I have over the years. I'll be honest with you. One of the things I try to do, I have a little poor man's covered call golden rules. And part of it is buying stocks when they're tremendously down. There's a lot that goes behind that. And some people say they want to do that with an uptrending stock. I've found success when I buy that great company. I did it with Merck and Bristol Myers a couple of years ago when they're pounded, right? They had some bad news. And when I bought that in the money leap, I paid pennies on the dollar. And as this thing starts to move, I put myself in a very favorable position to have that stock price go higher, my call leap option go higher. So I can write those 30-day calls collecting the money. But that's my approach. It's sort of my golden rules to the poor man's covered call. And by the way, I'm going to do a poor man's covered call video, and I'm going to talk about that. So for the person that asked that question, of course you can do that strategy. People do it all the time.
Yep, that's right. The poor man's covered call was your last presentation. So that obviously is something you do. All right. Well, John, it's been a great, exciting presentation, energetic as always, and lots of audience participation. So I love it. Everybody go check out his YouTube channel and go check out his website and learn more about a guy who's been doing this. When you've taken any option strategy and you've experienced continuous success with it, and you hone it and you learn lessons like John just taught you, where you don't necessarily trade the same stock with a covered call approach every single week for various reasons, that you've got to put some of them on the bench sometimes. All the different wisdom that he's developed over the years. That's how you become a great trader, by honing and honing and honing your skills as a trader. And those are the kinds of people that we like to bring on the Options Tribe every week. So thank you, everyone. And thank you, John, for a great presentation. We'll have you back. Definitely. Have you back soon. You take care. Enjoy yourself.
Definitely. Well, hey, Seth, real quick, I want to say thank you for this opportunity. And of course, I'll come back anytime. And for all those that have listened tonight, remember, go to YouTube, search Core Position Trading, and subscribe to my channel. Hey, look, be safe, be healthy. Most important, be lucky. Until next time, may all your covered calls be profitable.
All right, you take care, John. You're the best. All right, talk to you soon.